Capital financing. In this chapter, we're going to look at how a company funds the purchase of assets or investments in projects. And it chooses between two different types of capital. It chooses between equity, which is ownership, and debt, which is borrowing. So as a refresher, when a company makes a capital investment, it's building the assets of the business. When a company uses capital financing, it's going to increase either the debt or the equity in the business and balance the balance sheet out. In the coming lessons, we'll be looking at different types of debt and equity that companies can use to fund the purchase or the investment in these assets. Let's look at the business life cycle as it relates to a company's capital financing options. If you look from left to right on this chart, you have a company life cycle that begins with a launch, then growth, shakeout, and maturity. The first metric that we can plot on this chart is sales or revenue, starting from zero, ramping up through growth, plateauing at maturity, and potentially declining or extending through a life cycle extension and continuing to grow from there on. Beneath that, we have profit. Profit lags revenue, as companies typically take a while to grow their revenue beyond their expenses after they launch. And then finally, we have cash flow. Cash flow lags profit because initially, capital is required to make investments, which pushes cash flow more negative than profit. But in later years, the benefits of those capital investments kick in, and cash flow will actually outpace profit. So we have this general life cycle of a typical business, and this is just a broad generalization. But if we use this business life cycle as a framework, we can then plot on the same chart the general business risk over time, which is extremely high when a company launches and is unproven, and declines over time as it matures. Now, it may go back up again later if it's truly in decline, but generally speaking, business risk is declining over time, which means there's an inverse relationship to a company's ability to get debt funding. A brand new startup is almost surely unable to get debt financing and will have to be all equity, whereas a mature, established business is able to use a lot of debt funding and might not have to use as much equity, although equity is generally available across the entire life cycle. So we can think about this in the coming lessons as we look at capital financing alternatives for companies and for projects or investments of any kind. Simply put, the capital structure of a firm is the proportion of debt and equity that it's used to fund its operations and finance its assets. So to optimize the capital structure of a firm, companies decide if they want to add more debt or add more equity. Here's an example of a company with $1,000 of assets that has a low degree of leverage in its capital structure. So it has $800 of equity and only $200 of debt to fund those $1,000 of assets. Now let's look at the same company with the same assets but a different capital structure. This time a high degree of leverage is flipped with $800 of debt and $200 of equity. So here's an example of how a firm can finance the same assets with a different proportion of debt and equity. Generally speaking, the optimal capital structure has a number of factors. One, the current economic climate as to what type of funding is available. The business's existing capital structure, perhaps it does not have any more room for additional debt, or maybe it does. And then the business life cycle stage, which is a proxy for the overall risk of the business. Having too much debt, on the one hand, increases the risk of default. But having too much equity may dilute earnings and may not create as much value for investors. So it's important to strike the right balance between debt and equity. Ideally, a company wants to lower its cost of capital. So it uses a combination of debt and equity to hit the sweet spot where cost of capital is the lowest. In this diagram at point A, a company is all equity financed. And since the cost of equity is higher than debt, this is a fairly high overall cost of capital. At point B, on the other extreme, the company is almost all debt financed, which makes the company very risky because it doesn't have an ability to service that debt. And so the cost of capital is high again. But in the middle at point C is a sort of sweet spot where debt and equity are properly balanced, and the cost of debt, which is lower than equity, brings down the overall weighted average cost of capital. Weighted average cost of capital is simply the proportion of debt and equity a firm has multiplied by their respective costs. The cost of equity is the required rate of return that shareholders expect for investing in the business given its level of risk. The cost of debt is the required rate of return that lenders want for investing in the business given its risk. Ultimately, firms want to have the lowest weighted average cost of capital as possible. All else being equal, using a lower weighted average cost of capital or lower discount rate increases the value of an asset. Now let's look at an example of how to calculate WACC using the formula. We've got the formula written above, and now let's look at some specific numbers. Here's a company with $225 billion of assets, funded by $32 billion of debt and $193 billion of equity. That translates to 14% debt and 86% equity in terms of the total capital. The cost of debt is 3.5%. The cost of equity, or required return for shareholders, is 9%. Now we multiply each of these out. We then add them up, and we get the weighted average cost of capital of 8.2%. To learn how to calculate WACC from scratch using the full formula, be sure to take our Business Valuation Modeling Fundamentals course, where we will provide many examples and detailed calculations of how to calculate WACC for a company. In the coming lessons, we're going to look at how a company can optimally finance its business through a mix of debt and equity. At the bottom of the capital stack, we have equity, which is the highest risk and highest expected return. Then we've got subordinated debt, which is less risky than equity and less return profile. And then above that, you have senior debt at the top of the capital stack, the most secure, the safest, and the lowest expected return. So in the coming lessons, we're going to break down each of these three sections of the capital stack. We'll start at the bottom with equity, typically the first piece of financing that a company gets, and the highest risk and reward profile. Then we'll move up all the way to senior debt, the safest being the last one that we cover. All of these various types of funding can be easily understood through the lens of risk and return. As long as we understand how risky the type of capital is, we can appropriately price it in terms of the expected rate of return that should go along with it. Let's look at the various types of equity that a company can raise. Broadly speaking, there are three types of equity. Common shares. These shares represent the last liquidity position for investors and have the last dividend-paying position. What that means is they're left with whatever remains if a company is ever sold or liquidated, after all of the debt is repaid and all of the other types of equity are paid out. The same goes for dividends. After a preferred dividend is paid, whatever's left remains for common dividends. Above that, we have preferred shares. Preferred shares have a higher liquidity position, which means if the company is sold, they get paid out before the common shareholders. They also have a higher dividend priority versus common shareholders, meaning they would be paid a dividend before any common shareholders. And then above that, you have the highest equity liquidity position in a shareholder loan. There is no dividend attached to a shareholder loan, but it can pay interest. When a company is raising money, it will have to weigh the pros and cons of each of the various types of equity. It will look at the cost of each type. Perhaps the common shares are extremely costly with the highest expected rate of return, so the company prefers to avoid them. Or it could be the opposite, that the preferred shares are so costly in terms of their dividend requirements and liquidity positions that the company would prefer to issue common shares. Of course, it all depends as to where investors are willing to invest and where the company is willing to issue shares. And when there's a match and the company and the investors are aligned, then they have a deal and they're able to raise money at that category of equity. Sources of equity capital. Broadly speaking, there are two main sources: private markets and public markets. Within each of these, we'll take a look at how a company typically progresses. At the very beginning, companies are often funded by their founders or friends and family. This will be the very first capital that's put into a new business. From there, as the company grows, it may reach a stage where it can raise venture capital money. Venture capital is still very early stage for extremely high growth businesses. Moving on from venture capital, as a company matures a bit more, it may make sense to raise money from a private equity firm. Private equity firms vary in terms of their strategies, with some investing quite early stage with high risk and high growth, and other private equity firms investing in more mature businesses that are stable and predictable. So private equity is a very broad category, but generally speaking, it's more mature than venture capital. So in terms of private markets, these are your three basic categories, with each of the categories having many subcategories underneath them. So in all three stages here, companies are able to raise private money from different types of investors. Then at some point, they may go public with an initial public offering or IPO. Then they can raise equity capital from institutional investors, which make up the bulk of the public markets, and from retail investors, which make up a smaller portion of public markets, but are also important for raising money for companies. So as you can see, the sources of equity that a company has available to it largely depend on the stage of the company, whether it's a public or private company, and whether it's very early stage or whether it's grown to a state of maturity. Let's take a closer look at private equity and venture capital firms. They typically invest pools of funds that represent opportunities to earn high rates of return, but that take high risk. They then exit those positions anywhere from 5 to 10 years later via an initial public offering or sale to another private equity firm or a strategic buyer, etc. There are generally two types of private equity. The first is venture capital, which is the early stage, high growth, high risk businesses. Examples of venture capital firms include Sequoia Capital, Y Combinator, and Andreessen Horowitz, just to name a few of the more commonly known ones. And then the other category is buyout firms. Buyout firms invest in more mature businesses where they use a lot of leverage, and they try to maximize the internal rate of return that they can earn by borrowing money and leveraging up the company. Common examples of buyout firms include Blackstone, KKR, and the Carlyle Group, just to name a few of the more prominent private equity firms. So as you can see, there are two general categories, but within each of these categories, of course, there are many different types of strategies and different approaches to investing. One thing that both groups have in common, though, is that they typically plan to exit anywhere from 5 to 10 years after making their initial investment. So in terms of an exit, they can generally have a total exit or a partial exit. Let's take a closer look at what that means. A total exit would be selling the entire company to either a strategic buyer, which is another operating company, or to a sponsor, which would be another type of private equity firm. On the partial exit side, you could have a private placement, which is where some of the shares of the company are sold, either to a strategic buyer or to a sponsor. There could also be a restructuring of the company, where some new investors are brought in and some old investors are taken out. And sort of as a hybrid between a total and partial exit, you have a flotation or initial public offering, which is where the company goes public. And depending on how the IPO is structured, there may be a large secondary component, meaning that the initial investors are selling a lot of their shares. Or it may be that the company is mostly raising new money and the initial investors are not selling so many of their shares. So it really depends on the initial public offering and how many of the original investors are selling their shares into the IPO. Because of the fairly fixed time horizon that private equity and venture capital firms have, these types of investments are very different from the typical institutional and retail investors you'll see in public markets.